Good afternoon. Welcome to the February 25th, 2022 edition of News from the Front Lines of Business by DW Health Consulting. Okay, happy Friday, everybody. Looks like we made it through another week here. And this week's Fun with Numbers is 37, so in the Wallens area here, we're wrapping up the carnival season here. Mardi Gras is right around the corner. Endymion tomorrow, 37 floats, so it's another good parade. Happy to see things rolling with a kind of normal size parade, even though the route's a little bit shorter. So anyway, it's going to be another unproductive weekend because of parades, but should be a good time as we kind of can't help but be reminded that the Lent season is upon us here pretty soon. So, if you're Catholic, no meat on Friday and giving up stuff and all that's right around the corner. So definitely want to squeeze in all the fun we can this weekend. All right, so news in the front. So this week, busy with taxes and all that stuff, but we also had a number of new client meetings, and one of the topics that comes up pretty frequently is this first point here is the decision to, when you first start up, do you want to be a sole proprietor or an S-corp? So we'll just kind of revisit that for a minute here. So when a new business comes in, typically when people are starting out, they'll go to the IRS website, get an ID number, get their bank account set up and that kind of thing, and usually it's one person doing it. It's probably the most common situation we see. So by default, that's a sole proprietor, Schedule C, and you can make these elections to be taxed as an S corporation, right? So there's some benefits there when you tax as a corporation, because there's ways to set things up where you can save some money on self-employment tax compared to the sole proprietorship. So what's kind of almost like a knee-jerk reaction is when you go see an accountant or a tax person, they automatically start making a selection to be taxed as an S corporation. And we don't want to automatically do that just because the S corporation has another tax return, so there's some additional cost involved in operating an S corp as opposed to a sole proprietorship. So sometimes the tax savings, if you're just starting out and you find yourself where the income is below what we find to be around $50,000 or $60,000, the extra cost of the S corporation doesn't outweigh the tax savings. So sometimes you just let it alone for that first year and see how things go. And also keep in mind too, when it comes time to making that decision to be taxed as an S or a sole proprietorship, there's a way to retroactively go backwards. So this is not the kind of thing that you want to just jump into automatically. Definitely want to spend a little time thinking it through. And if worst comes to worst, you can always make that late election, because that's still available as of now. So I just want to throw it out there, because anytime a new business starts, that topic comes up all the way. These LLCs get formed and they don't really know which direction to go tax-wise, and generally let it be a sole proprietor for a while until you kind of get a little better idea of what the results of the business are going to be. Know your numbers, so always going back to the QuickBooks and the accounting and how important that is, and that is coming up over and over again. So particularly now as we're in tax time, we find as people have kind of gone through the year here and didn't do a good job of kind of staying on top of things. Some people having some unpleasant surprises with the tax situation that we could have fixed if we would have kind of looked at it earlier. So I just want to reiterate that. So know your numbers is kind of our main. So our tagline is the main thing we always focus on, and everything starts with kind of knowing the numbers. So whether it's a goal number or where you are number, I can't stress enough how important it is to commit to that on a daily basis, review how things are going, and take action based on that. So, or ask for help interpreting it if need be. But I definitely letting it go to the end of the year and then thinking you're going to fix it at the end of the day, it's turning out to be a bad decision. So every day, know your numbers. Can't stress that enough. Another discussion we had, this is going back to our investment topic here, is we're always talking about real estate when we leverage, and there's a few other topics that always come up. But another rule of thumb somebody told me today, I know I've heard this before in other places online, and this is a local guy who's had a great deal of success with his investments, and it's this 1% rule. And this kind of goes into like when you're deciding whether or not to purchase a income generating rental property, residential rent. This is residential we're talking about here. But the purchase price should always be, well, I guess it's really the revenue that you generate. So you look at that, how much rent revenue do things generate. So if it's a $100,000 property, you want to see $100,000 a month of rent. So you can kind of flip that the other way, and if you know the property is generating $1,000 a month of rent, you want to pay $100,000 for it. So by keeping that relationship in order, that avoids you ever overpaying for a property, which is the big thing. So we want to keep in mind that capital appreciation is one of the things we kind of want to watch with our real estate investments. And if you pay too much for a property, and you can't generate the amount of revenue, chances are it's not going to increase in value to make all the numbers work with the financing and some of the things we might want to do later on, where we refi and pull some cash out of the property, harvest some equity to use otherwise. So if you get too far away from this 1% rule, things aren't going to work out as well as you would hope. And also, I guess, going back to the income side of the equation too, we want to make sure that if you pay $200,000 for a property, you can generate $2,000 a month in rental revenue, because in general, that's what's going to be, that's the number it takes to make everything work. So that accounts for real estate taxes, more debt service with the mortgage, and a repair ratio. So that that 1% rule worked very well in a kind of a real world situation with a client, and it came up. So I just want to reiterate that and make sure you're aware of this kind of rule of thumb that's out there, and seems to work in a lot of cases. I've heard it more than once, and just want to make sure we mention it. Also, we just want to mention we started working on, I don't know, we started off trying to do a 10 commandment rule for rules for kind of some general rules for successful business growth, and it's work in progress. But basically, so far I've come up with 6, and it ties back into our know your numbers idea here. And we get back to the beginning of the progress. We want to have some kind of target. So knowing our number that we want to hit is kind of big. And once you have that target, developing a step-by-step plan. So look at that number, analyze what it's going to take in sales to get there, and based on that amount of sales, how much is going to be needed in the way of overhead expenses. Commit to those daily activities. So we mentioned that before. So once you've had the plan in place, don't just put the numbers on the shelf and kind of put them on the side and forget about them. Look at those numbers and in your progress towards those numbers on a daily basis, and make sure that you're making taking action every day that moves you towards those goals. So the monitoring, I guess, is kind of an offshoot of committing. So I guess we want to make sure we have reports and tracking in place that allows us to easily see where we are and measure that, because what gets measured gets managed. So we want to have certain metrics. So if I guess if you have a certain number of appointments per day that generate, so if you have 5 appointments per day, and every 5 people you talk to, one's going to become a client, and one client generates $1,000 a month in revenue, we want to make sure we're doing what we got to do to have the right number of activities. So it's different for every business, but that's something we want to kind of set up. And I guess don't get too tied up on the $1,000 a month revenue, but if it takes 5 phone calls a day to generate enough revenue to hit that monthly target, then that's the activity we want to focus on. Doing things that we know will pay off with the right amount of revenue. So monitor, measure, etc. And then laser-like focus. So we find don't get distracted. That's easy with the especially when you're a small business and you and the hustle and bustle of what goes on every day. But we want to make sure that we either write down that target number of phone calls it takes, or client meetings it takes, or whatever it takes that we know it's going to generate revenue, and focus on just that thing. And don't let the dealing with your electric bill, or all your day-to-day stuff that goes on when the mail comes in and things like that. Don't let those things get you off your focusing on your target for very long. Make sure you get back to it. And lastly, we always say adjust the plan if needed. So we don't want to compromise on our end goals, but we may need to adjust it. So if that example before we said 5 phone calls makes the right amount of sales transactions happen, and somehow we see we're not hitting it, maybe we need to go up and figure out a way to make 7 phone calls in order to hit our numbers. So adjust the plan as needed and focus on the right things, and you should hit your target. So this is the work in progress. I'm going to flesh this out some more as time goes on and develop it. So, but anyway, so here we are at the end of it. So our closing thought, and just keep stressing this attitude of gratitude here. And I came across this one today from not a philosopher I've heard of before, this Moko Kama guy. But anyway, appreciating what you have is the best cure for missing what you have lost. So it seems lately there's been lots of, seems like more than normal number of people passing away and just things changing. So I definitely want to, I guess, refocus things on what you got in front of you right now, what you have, and because it's what you have is always probably better than you may think if you focus on the wrong things. So let the lost things go and worry about what's in front of you and what's in your hands. So that's my thought for closing this out here. So that's it for this week. We will be back next week in full blown Lent mode the next time you hear from me. And have a good weekend, and we'll see you then.